Hi, this question 2.4 is looking at the income statement, preparing an income statement and a statement of financial position for a sole trader. And it's a very introductory type question. So in these questions, you're given a trial balance. You're told to prepare an income statement and a statement of financial position. And you're given the trial balance, and it'll have two columns, one debit and one credit. So the left is debit, the right is credit. And at the end, underneath the trial balance, sometimes there are adjustments, and one of the adjustments here is closing inventory is at the year end is €4,166. And in further questions, there'll be a lot more adjustments we have to account for. So the first thing we'll do is the income statement, and to do that, you need to identify the income accounts and the expense accounts. The income accounts will be on the right-hand side, the credit side of the trial balance, and the expense accounts will be on the debit side of the trial balance. So I've identified the income accounts here. There's only one, which is sales, on the right-hand side, on the credit side, and on the left-hand side of the trial balance will either be expense accounts or asset, and expense accounts are expenditure on short-term costs, running of day-to-day costs of running the business. So your purchases, which is a cost of sales expense, and then these others, rent, light and heat, salaries, insurance, are expenses, sundry expenses, motor running expense, clothing expense, and then the remainder of them, they're assets. Payables is a liability, receivables, fixtures, buildings, they're assets, they're expenditure on items of which the sole trader is going to receive a long-term benefit. So they're recorded separately in the statement of financial position. So here our income, and basically to get our profit for the year, we say our income statement is our sales minus our expenses. Now we have to do an adjustment for cost of sales, and our purchases is going to get reduced for any closing inventory, because if during the year we purchase goods worth 23,803, if we had some remaining at the year end unsold, well, really, they shouldn't be compared against this year's sales because they're going to be sold next year. So you always reduce the purchases figure for any closing inventory. So here's the income statement, starting our sales account. If there are any sales returns, we'd reduce it for any sales returns. There are none. We have our purchases figure, which gets reduced for the closing inventory of 4166, which here is our purchases figure, and we reduce it for the closing inventory. So our purchase really this year is only 19,637, gives us gross profit of 9157. And then from our gross profit, we add any other trading income, which we've none, and we take away the expenses to get a net profit of 2973. And that net profit then will be carried down to equity in the statement of financial position. We'll see that figure again. So our statement of financial position is basically your assets on the top half, and on the bottom half is the equity accounts and any liability accounts. So once again, we just look at the trial balance, identify the type of accounts. So here I've identified the assets. Buildings, fixtures are non-current assets, long-term assets. Receivables are customers that owe us money. And for goods bought on credit, they're a short-term asset or a current asset. Cash at bank is a current asset, and motor vans is a long-term asset. So when we do our assets, we divide the non-current assets together. So buildings, fixtures, and motor vans will be shown together, and the current assets of receivables and cash at bank. And always your inventory is a current asset. So inventory affects two items. So that the journal entry for closing inventory is debit cost of sales and credit. Sorry, it's debit inventory and credit cost of sales. So closing inventory is always a current asset as well. So we'll have that in our current assets also. There was a line item there for motor van. Just ignore that. That shouldn't have been there. So here is the statement of financial position. You always put the title and the year end. There are the non-current assets and the current assets. And remember, closing inventory is always below the trial balance as a note or an adjustment. And the total assets are 67,679. Then we show the equity and the liabilities accounts. So we've only one liability account, and liabilities are always on the credit side or the right-hand side of the trial balance, payables, and then two equity accounts, capital and drawings. And capital is always on the credit side, and drawings is a reduction of capital, so it has to be the other side. And we just put them into the trial balance, into the balance sheet or statement of financial position. So here are equity, those three accounts. The retained earnings, 2973. You remember we calculate our net profit. It was up here. It was 2973, and that just gets carried down. The 2973 gets carried down to your equity. Our current liabilities are there, and then the total equity and liabilities is 67,679, which is the same as the total assets. So that's the statement of financial position. The total assets should agree to the total of the equity and liabilities, and there is the statement of the income statement. Sales less cost of sales gives you net profit. Thanks for watching.